The SBA 7A loan program is an extremely powerful tool when it comes to growing your small business empire and ultimately creating generational wealth. You can use it for all sorts of things, from acquiring an existing profitable business to buying real estate for your business and more. And some projects may require an equity injection. But how do you know when and how much and what can count as equity injection? Hey, I'm Ray Drew, an actual SBA lender, and after watching this video, you're going to understand the SBA's equity rules better than your banker. First off, what is equity? Equity can mean a lot of things to a lot of people. For a business, the owner's equity is determined by looking at the balance sheet, assets minus liabilities. And when a bank talks about an equity injection, they're referring to an infusion of assets into the business. And that's going to increase that number. And usually this is done in the form of cash. Now let's talk SBA. There are three and only three scenarios where the SBA absolutely requires a specific minimum equity injection. And those are startup businesses, business acquisitions, and some partner buyouts. The determining factor on partner buyouts is whether your balance sheet has a debt to equity ratio of 9-to-1 or better. Basically, if you have 10% equity on your balance sheet with the proposed debt, then you're good. No additional equity is needed. But if you're overly leveraged and have a greater than 9-to-1 debt to equity ratio, you're going to need to bring in a 10% equity injection, a cash infusion coming from outside of the business. And if that's confusing at all, and it is, just call me. Now, for all other projects, buying real estate, buying equipment, opening a new location, whatever, the SBA does not have a minimum equity injection requirement. Those could potentially be financed at 100% financing, but it depends. Here's what the SBA says on equity injection for all those other types of projects. Basically, the lender makes a determination as to whether an equity injection is needed, and if so, how much. And the owner's equity on the balance sheet should be the driving force behind that determination. So if you go walk into the bank and tell them you want a 7A loan to go buy your building, and they tell you that the SBA requires a 10% injection for that, they would be incorrect. And this happens all the time. And this sort of make the SBA the bad guy is a common maneuver used by banks to cover up their own incompetencies. Let's do a little experiment. Next time you're at your bank, inquire about an SBA 7A loan for real estate, and then comment down below what they tell you. But I already know what they're going to tell you. They're going to tell you one of three things. Either yes, we can do it with a 10% equity injection, or they're going to say maybe we should be considering the 504, or possibly they're going to say you don't want to go SBA. All of these are very common by banks that just don't really know SBA that well. Here's how I see it. If you're a business that has been operating for a while, and you don't have a bunch of debt, and you don't treat the business like a piggy bank, you reinvest and build equity, chances are you're going to qualify for 100% financing for all those other types of projects, including an owner-occupied commercial real estate purchase. Some banks just have their own rules, which is fine. I just get frustrated when they mix up their own rules with the SBA rules because it causes a ton of confusion. Now, let's say an equity injection is needed for your project. I'll use a specific example. Let's say you're buying a business and you need to inject 10%. First thing you should know is it's not 10% of the purchase price, it's 10% of the total project cost. And the total project cost usually consists of three things: the purchase price, the working capital, and the closing costs. And that's for a business acquisition. So the cool thing about this is you can acquire an existing cash flowing business with just 10% down. And the SBA actually allows the seller to contribute up to half of that 10% in the form of a seller note if they place it on full standby for the life of the SBA loan, which is usually 10 years for a business acquisition. So basically the seller can't get repaid on that 5% note until the SBA loan is paid in full. In any event, if you're injecting the 5% or the 10% or possibly more, because the lender could require a larger equity injection, because remember, the SBA is just setting the minimum. That injection is going to be cash. Now, ideally, you have the money sitting in an account seasoned for 60 days, and it's your own personal savings. It also comes from a brokerage account. You can even tap into your retirement for this. There's a pretty common program that a lot of SBA borrowers use to access their retirement tax and penalty free. It's called the ROBS program, ROBS. But what if you're a little short on funds? Well, here's two other possibilities to come up with your equity injection. Number one would be a gift. a family member can gift you some funds. They're just going to need to produce a gift letter and bank statement showing that the funds were in their account for at least 60 days. And then 2, you can use a home equity line of credit or HELOC. And that can be used to tap into the equity on your house, but you could only use that for your equity injection if there's an outside source of repayment for that debt. In other words, they don't want the business you're about to buy to repay that debt. So for this to work, you're going to need W-2 income, or a spouse is going to need W-2 income, or you're going to need investment income, rental real estate income, something to repay that HELOC outside of the business that you're buying. Now, once you've determined where the funds are coming from, now we have to document it. This is one of the top 2 or 3 things that the SBA just absolutely hammers lenders on that are making 7A loans. It's always a hot button issue. Sometimes it's easy, other times it's confusing and burdensome. Let me explain. Let's say it's November 8th and you're closing on your SBA loan today, and you're bringing $100,000 to closing. You will have provided your September and October bank statements and a current bank statement for November through the day of closing. And throughout that entire time, the minimum balance was above $100,000 and there were no large deposits made during that period. This is perfect. You're done. This is the best case scenario, but unfortunately it's not always that easy and clear cut. Let me give you a recent example. There's 2 partners and they're buying a business and they need to put down $50,000. They're each bringing $25,000. So we get their last month's bank statement and the $50,000 is there, but it wasn't there at the start of the month. There were 2 large deposits entering that account earlier that month for $25,000 each. Where did this come from? Oh, well, we transferred the funds from our individual account into our joint account. Oh, okay, no big deal. Just give me your last 2 months statements for each of those accounts. Okay, so I look at one account and the balance was over $25,000 for the previous 60 days prior to transferring that money to the other bank account. That's good. Now I look at the other and the beginning balance of that account was only $5,000. And there were these other 2 $10,000 deposits coming from another account. What's that account? Oh, that's my Wells Fargo account. Okay, well, I need 2 months bank statements prior to the money going into there from that other account. So now I can see that the $20,000 was there for the 60 days prior, 7 bank statements later. So you can kind of see how we can start going down a rabbit hole with this thing. And that's not nearly as complicated as some of the ones I've seen. And it's impossible to cover all the different scenarios in this video, but at least now you know what to expect and can prepare accordingly.
So there you have it. If you found that video helpful and you want more expert advice from an actual SBA lender, then I would invite you to hit that subscribe button because I've got plenty more where that came from.